Shall we? So this is Adrian speaking. So hopefully the sound's coming through loud and clear. If you can hear me, please do let me know. Today we're going to be talking about some trading essentials and also how to build a trading plan. So there's actually a lot to go through. I was going through the slides earlier and thinking, my word, we're going to be hard pressed to cram all this in today, but we're going to give it a blooming good go, aren't we? So like I said, let me know the sound's coming through for you, please. We're casting on GoToWebinar as usual, but also on YouTube and LinkedIn and Facebook and goodness knows wherever else. And I want to try and make it as sort of interesting and as action-packed as possible. The subject matter today, it's kind of beginner level, but some of it actually is stuff that we should probably all be doing, and sometimes we forget it. So the bit about trading plans, if you don't have a trading plan, you're not too sure what it is, then it's absolutely essential you stick with today's session. Okay. Now on GoToWebinar, I am sharing my webcam. Is that coming through? I just want to make sure that's visibly that's okay. I say visibly it's okay. I mean, I may not look okay, but is it actually working? You can let me know. I'll be interested to see. I've never actually done a webinar, a webcam on a GoToWebinar before. Anyway, let's get on with it. So look, what are we doing? First of all, let's just check that everything's working. You can ask questions in today's session. It is live. It is interactive. We are talking right now. So just let me know. You can type into, if you want to go to webinar on the laptop or desktop version, look something like this. You can click the orange button, allow you to type in here. If you're on the app, so on the mobile or maybe on a tablet, something like that, you can click on the questions button there, and then you can type in there as well. All right. So like I said, if you've just tuned in, please just type something in. That'd be fantastic. Okay, so I'm not sure if the webcam's actually working. So let me just see if I can check with that. Looks like it's struggling. I'm going to turn that off. Okay, let's get going. So, trading essentials, building a trading plan. That's what we're going to go through. Some of the fundamentals that are essential for traders. If you're sitting there thinking, "God, Adrian, I just want to get some live trades," that is not today. Okay, we do other sessions on Tuesdays where we talk about live trades, trades are setting up right now, and so on. This is about bringing it down to the basics. Now, some of you might well be brand new to trading. Some of you might have been in trading for a long while. Whatever it is, this is going to go through those fundamentals. Make sure you got the building blocks in place, particularly the bit about the trading plan. Okay, so even if you traded before, you may not have a plan, you may not have thought about everything that you should be thinking of, in which case that's what we're going to go through today. It's going to be a whistle stop tour. I've got to try and cram as much into this next hopefully about 45 minutes or so as I possibly can. Okay, now keep those questions coming through. You can type those questions into the questions box and I'll endeavour to answer every single question if I can. So as we go through today's session, spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. Okay, so let's get going. So in terms of the trading essentials before the trading plan bit, this is what we're going to go through today. The different types of markets, some of the pros, some of the cons, talk about what pips are versus points and so on, leverage, how you can go long and short, tax implications. I'm not a tax advisor, I don't pretend to be, but we'll give a bit of an overview on that side of things. Types of different trading accounts, and also a few different examples, how it all works when we apply it to trading platforms as well. Okay, so let's get on with that one. Now, in terms of markets, really, yeah, there are additional markets, I suppose, like bonds and things, but really these are the principal markets that one would trade. Forex, biggest market really in the world. I like Forex because it's quite low cost. It tends to have quite a consistent speed in which it moves. I quite like that. So most currency pairs move at similar sort of speeds. You have your dollar majors and then you have your crosses as well. The way I generally look at it is to trade. If you're going to trade currencies, if you're going to be more active trading with them, trading over a sort of couple of days or less, then you've got to be a little bit careful about the spreads and the dealing costs associated with them. So trading a currency like a yen, a dollar, a pound, a euro, New Zealand dollar, Australian dollar, and so on, those are fine. When you start bringing in some of the other types of currency pairs, maybe a zloty or something like that, it tends to get quite expensive to trade. So just be a little bit mindful of that if you are going to trade foreign exchange. Typically, you can trade that at 30 to 1. That means for every, in terms of the leverage that's available, so you can trade, if you put a pound in your account, you can buy 30 pounds worth of pound or dollar or whatever it is. Okay, so there's pretty good leverage available on currencies. Like I said, I like them because of the almost evergreen nature of them. They trade 24 hours, 5 days a week. And like I said, there's a consistent, decent enough speed with them. Indices are a bit more feisty. They'll definitely move quite a bit faster in percentage terms, but in points terms as well. So bear that in mind. Leverage is a little bit lower because of that. You don't quite have the same borrowing power or buying power as you do with a currency pair, but then you don't really need it either. So the main indices would be the S&Ps. Interestingly, in the UK, people tend to trade the Dow a whole lot more than they do the S&Ps, which is odd actually, but it is what it is. The liquidity is really in the S&Ps. And then you've got things like the DAX, the FTSE, the Nikkei, Hang Seng, and so on. These are all good markets to trade. The ones that are, I would say, the indices are probably the best to day trade. So if you're looking at being in and out of the markets quickly over, say, 10, 20 minutes, an hour, what you tend to get good is very good volatility compared to the cost of trading them. And last Tuesday, and you can see the recording on Facebook and YouTube, if you look at how to trade the 2-minute chart, I did last Tuesday, did a live cast on that, so you can find out a lot more about how to trade the Dow and the DAX, etc. The major commodities that people trade, gold, silver, oil, they tend to be the major ones. You can trade some other markets like wheat and so on. A lot of brokers don't quote so many commodities these days, and that's because the cost of the exchange, of the data from the exchanges themselves. So, that's probably the biggest outgoing. One of the biggest outgoings for a broker is their exchange fees. So the live prices from which they push those prices to you, they have to pay a huge amount of money to the exchanges for those prices in the first place. What we typically find is that commodity prices are very expensive, and actually not that many people trade them. So what you'll find is that, yes, most brokers will offer gold, most will offer silver and oil and so on because they're popular markets to trade. Wheat, soybeans, and all sorts of pork bellies and whatever else, frozen concentrated orange juice, goodness knows. These are markets that are less actively available on brokers these days, simply with the cost of doing the business is not necessarily there. Typically, sort of 20 to 1, 10 to 1. It depends on the commodity itself. Okay, how to check the YouTube recordings. Just search for trend signal on YouTube. That's probably the easiest thing to do. And you'll see our channel with our branding on and so on. Okay. Or search for, trend signal screen share. You'll find it quite easily, I think, CG. Okay. What else have we got? Stocks and shares, they're pretty good. I do like trading stocks. 5 to 1 leverage available there. So if you put £1,000 on your account, you can buy £5,000 worth of stock, which is great. You can trade the UK shares, typically US shares, and a lot of markets otherwise. And typically this can be all over the different. You hold it for a number of days and so on. Lots of brokers offer that. And then cryptocurrencies, some brokers offer them now, some don't. It depends on where the broker is situated and where you're situated, to be honest with you. But sometimes you can get things like one-to-one on different cryptocurrencies. Sometimes you can't, it depends. But either way, cryptocurrencies are becoming increasingly popular over the last few years. That said, probably less popular as this year has gone on because they've taken quite a bath, haven't they? In terms of the markets, which are the best markets to trade, that really depends on the strategy and how long you have to trade the markets. I would say, if you're wanting to day trade, typically, I tend to find that indices are probably the best. Intraday trading and probably end of day trading, you've got foreign exchange and commodities. They're okay for day trading, but can be a little bit more expensive. You can get some good volatility in there, but also good for end of day trading as well. Stocks and shares, a lot cheaper to trade these days. So it really depends on what your background is. There's a lot of choice. Costs can be a lot more affordable as well. But typically, often with stocks, you're holding trades for a few days, a few weeks, something like that. And cryptocurrencies, I would say for trading, maybe slightly for the more experienced trader because they are a significant amount faster than other markets in percentage terms. So to give you an example, Bitcoin moves approximately 10 to 13 times the speed at which euro dollar moves in percentage terms. So quite a lot faster. Okay, we'll talk about trading plans and different markets just a little bit later on. Now, in terms of the brokerage account that you go with, I know some of you will perhaps trade with markets.com, some of you with IG, some of you with whoever else it may be, ETX Capital or Overlex as they're now called. What I've got here is a bit of information based on the different types of trading accounts that people typically have. Now, if you're in the UK, you have the ability to trade as a spread bet. You could probably still open a spread betting account if you're outside the UK, but it doesn't tend to be really available. I trade as a spread bet. Principally. It's very similar to a CFD, a contract for difference. So if you're trading outside of the UK, you're not familiar with what a spread bet is. A CFD is basically a spread bet just with different packaging, or I should say, spread bet is a CFD with just different packaging. So to give you an example, the move, if you're going to trade shares, for example, 100 shares in let's say you're going to trade 100 UK shares of BP or something like that, is exactly the same movement as 100 CFDs. It's exactly the same as £1 per point. That's on UK shares, by the way. The point is, the way in which they move is the same. The only real difference is to do with the costs associated with them. So there might be different dealing costs and so on. But by and large, the movement of which, the profit that you can gain, gross profit, I should say, is basically the same. So the main difference between these three elements, share dealing, CFDs, and spread bets, is basically packaging. If the market moves from 100 to 110, you can still do the same trade size across them and you can still make the same amount of money. The main difference is how much money you need to put down and then the costs associated with that. Okay. So what's the difference between a CFD and a Forex? Well, you can get margin FX where you tend to buy a notional value like £100,000 worth or $100,000 worth of the particular currency. With a CFD, it's brought down into a contract. So instead of trading £100,000 worth, you could trade £10 per point or $10 per point. It basically works out as the same thing. So again, it's just packaging, really. You still can trade on margin, whether it's a Forex account or whether it's a CFD account. There is really very, very little difference, to be honest with you. It's just down to whatever you prefer the look of, I would say. Spread betting, again, is very much the same. Instead of trading a number of contracts or a number of dollars, that all works itself back to a stake per point in spread betting. It's just, like I said, it's just different packaging. That's really all that it is. Okay. In terms of margin, if you're going to trade on a share dealing account, if you're going to trade BP shares, Amazon shares, by and large, you need to put 100% of the capital up. Okay, that's it. If you want to buy £1,000 worth, then you've got to put £1,000 on your account plus costs. Simple, really. When you're going to trade as a CFD or a spread bets, you get the ability of leverage. Now that's a double-edged sword, really. So what you have is the ability to have extra buying power. So if you had £1,000 on your account, if you wanted to trade Forex, you could trade 30 times that. So you could trade £30,000 worth on your account with £1,000 on your account. Now you might sit there suddenly think, wow, God, that sounds crazy, but not necessarily. That's a 3.3% margin requirement. How much does a currency pair typically move in a day? I don't know, probably 0.5, 0.7%, something like that. Sometimes a big day might be 1% move. So, really the margins are according to what a typical very, very big day is. Okay, so you seldom will you see a Forex pair move more than 2 or 3%. Indices, similarly, it's not very often you see a 5% move on an index, 20 to 1 you get on that. So with £1,000 on your account, you could buy £20,000 worth of an index, FTSE, for example. And we'll talk about notional trade size in just a second, commodities similarly, and stocks as well. Now, in terms of direction, if you're trading on a share dealing account, long only. You can only make money when markets are rising. That sounds normal, right? So how on earth can you do anything different? If you're brand new to trading, you may not be aware that you can make money by shorting the market. This is by pressing the sell button first. So if you think the markets are going to fall, then you press short, simple, or sell first, hoping to buy it back at a lower price later on. Pretty simple. A lot of people would say you've been trading for a little while, but if you've never traded before, that might be all very new to you. The great thing about that is when you trade as a CFD or a spread bet, you have the ability to make money on falling markets. That's great if it's a bear market. That's great if it's pound against the dollar and you think the pound's going to fall. It's great if you think the stock market is going to fall and you want to make money on a short. You want to hedge your portfolio by trading a CFD on an index like the Dow or the FTSE. You can do all of these things by short selling. And that gives you, actually, if you think about the stock market, you look at the FTSE, it's probably falling 40 to 45% of the time. And in which case, you could argue that if you can only go long, then you're missing out on 40 to 45% of the opportunities that are out there. The ability to short sell gives you that flexibility. And if you look at the way the stock market's been, what is it this year in the US is something like the worst first half of the year for 60 years or something like that. So the stock market has had its worst performance in the first half of the year for 60 odd years. It is something silly. The ability to be able to short sell and make money from falling markets is a big deal. Okay, it's very, very beneficial, and it doesn't necessarily cost you any more to do it. Tax-wise, now this is going to vary depending on, and this is again a bit of a top-level overview. Your tax will depend on your own individual circumstances, and this will depend on where you live. This is based on UK basically, but whatever you make on share dealing, unless it's within an ISA or pension, then it's liable to capital gains tax, and you can also pay stamp duty as well. So 0.5% when you buy shares is charged and goes to the inland revenue. Or HMRC, whatever they're called these days. Now, in terms of CFDs, you don't have to pay stamp duty on UK stocks, which is great because that saves 0.5% on your dealing costs straight away, which means the market has got to move 0.5% less on a CFD for you to be in profit, arguably. Capital gains tax is still there, so you're still going to make profits, so pay tax on your gains. Could argue though that of course gains is a nice problem to have. So if you are paying capital gains tax, it means that's because you're making money from your trading, which it's a nice problem to have. If you're trading as a spread bet, then it's tax free. It's tax free under current UK legislation. That is of course could well be subject to change. So if you trade it as a spread bet, it's not. It's based on basically betting duty, betting is classed as, and therefore there's no capital gains tax, and therefore there's also no stamp duty either. So from a tax perspective, spread betting can be extremely good value. Location wise, like I said, share dealing, you can do that globally. CFDs, most countries offer CFD trading or allow CFD trading, US being an exception, Belgium being an exception. There are a few others. There are some countries in the world that brokers won't accept customers from, perhaps because they've got high risk associated with them. But UK is typically a spread betting place. All right. Is this all making sense so far? Am I going too fast? Am I going too slow? Let me know in the question box. Remember, you can ask questions as we go through. You want me to recap something? Sometimes I go through this stuff and you think, oh, this is all okay. And yet people are sitting there, well, if she told me about this, so do type that in if there's something there. Okay. So which is right? Which is the right type of account? It kind of depends on what it is you want to do. Do you want leverage? Do you want that increase in buying power? If you do, then you can trade as a CFD or a spread bet. If you don't and you only want to trade stocks and you want to hold trades for longer durations, then a share dealing account is absolutely fine instead. It is very much down to you. The shorter the duration you want to go, the more sensitive you should really be about dealing costs, the smaller the movement of the trades are likely to be, and therefore the more attractive leverage becomes as well. Okay, so the shorter the duration of trade, if you're talking about trades that you're likely to hold for probably a month or less, the more attractive CFDs and spreads bets become from a cost perspective, okay, and also the flexibility perspective as well. All right. We get asked a lot about what is a pip, what is a point, and it's understandable, to be honest, because it can be blooming confusing. You've got different markets that are priced in different ways. And the pip and the point is something that also helps us to work out the notional value. And I've got a few different examples of different markets I'm going to go through now. The first one, again, some of you who are experienced with this, that's fine. But, some people are going to be brand new in this session today. So pound dollar. The dollar pair. And that typically, most currency pairs, unless they're yen, denominated, US dollar yen, they're traded to the 4th decimal place. Now this gets horribly confusing. If I dial back 5 years ago, 15 years ago, 10 years ago, most brokers would quote a currency to 4 decimal places. Okay, so there. What happened later on is as brokers got a lot more competitive and liquidity providers got a lot better, you tended to find that some brokers were suddenly becoming a bit more accurate with their trading. Data feeds were faster and they ended up getting a lot of arbitrage and a lot of sniping off quite slow or latent prices. And that created brokers quoting a fraction of a pip. And this is actually where pips can get a little bit more confusing because we typically still trade size on currencies based on the 4th decimal place. And yet, very often, Forex pairs are quoted in 5. And you think, God, what on earth is all that about? It's because it's like a fraction of a pip. The way I like to look at it is this. I know you got the pound. I know this price is way off from where pound dollar is now, but it doesn't matter. I didn't have time to go through the slides. But 1.3979. The way I like to look at it really is, it's not really trading at that. It's trading at 13979. 9.2. So if you think about that, so actually it's trading there, and that's 0.2 of a pip. Okay, so very often that's how I'll write it rather than actually 1.39792 because that gets confusing as to where the pip is. So really that's what the price is. It's trading at a fraction of a pip if it's trading less than the denomination. Now when you look at a currency or any market really with most brokers, they will increase the size, the font size of the pip it's being priced in. So when you look at a particular instrument, you'll see on most brokers, if not all of them these days, that this is trading from 78 to 79. Forgetting the 3, forgetting the 2, that's a fraction of a pip. If that moves from 78 to 79 to 80 to 81, that is 1 pip. Okay, we talk about pips when we talk about currencies, and we talk about points when we talk about other markets. Okay, does this make sense, everybody? Give us a quick yes or a no in the questions box. Like I said, a lot of the change that took place is really down to internet speeds and really having to be as accurate on the price as possible, really. Okay, so really, if a market's going to move up 10 pips, it would go from 139.78 to 139.88.3, if you like. And I know a mathematician would hate this, but like I said, it's almost like it's got 2 decimal points in there. Oh, that's not possible, Adrian. What are you talking about? Whatever helps you remember it. Okay, whatever helps you figure it out, doesn't matter. If you need to put a 2nd decimal point in, who cares? We're not at school anymore. Okay, so what that means is, and when you look at that, it gives us the ability to work out our spread. Now the spread, those of you not too sure, is the difference between the buy and the sell price. So this basically tells you how much the market needs to move in your favor before you are break even on that trade. So this quote had a spread of 0.9 pips. So from 78.3 to 79.2, that's 0.9 pips. So pound dollar, if you bought it, would have to go up 0.9 pips, all other things being equal, before you are break even, because the price you would buy at would be 139.72. That means the price you sell at is over here, so that's got to get up by 0.9 in order to match 139.72. Does that make sense? So basically, whatever you buy at, difference between these is your spread. That's how much this market has got to move in your favor before you are break even. Therefore, the wider the spread, the higher your implied dealing cost is. Okay, that doesn't mean to say that spreads with wider markets are bad to trade, but spreads with wider markets. Did I just say that? Markets with wider spreads are bad to trade. It just means you need to be mindful of, in my opinion, you need to be mindful of the speed in which the market moves relative to the spread, the dealing costs. Because you could quite happily have a spread of 1.5 instead of a spread of 0.9, but if the market moves twice as fast, actually this ends up being cheaper to trade. So, it's speed relative to spread is something. And again, I talked about that in last Tuesday's sessions. Have a look on Facebook, have a look on YouTube, just search for Trend Signal or Trend Signal UK. this then brings us the ability to work out what the notional value of a particular instrument is. So how do we do that? Notional value is the number of pips in the price times by the stake that you want to make. So how many pips are in the price? Well, let's change the decimal points. If I was going to buy at 139.79.2, 13979.2. That's the number of pips, because this is a fractional pip here, yeah? So forget this decimal point, don't need that there. So this is the number of pips that are effectively in the price, 13,979.2. That's the number of pips. So you multiply the number of pips in the price times by the stake. If you want to do that at $10 a point, a pound a point, whatever it might be, that will give you your notional value. That is effectively the sterling or dollar, whatever it is you're trading in, value of the trade that you are placing. So as a spread bet, you did £1 a point on pound dollar and you bought at 13979.2. The value of that trade is actually just that times by 1, because you're going to trade at £1 a point or £2 a point, £5 a point, £10 a point. You multiply it accordingly. That gives you the notional value. Okay, that's the value of it. So effectively, whenever you trade £1 a point on pound dollar, you're trading 14,000 pounds worth of pound dollar. Okay, that's really it. You think, my God, that sounds like quite a lot. It's not really. Remember how much the markets move. You know, if pound dollar moves 0.7% on a typical day, yes, of course it can move a lot more than that. But you know, that gives you a sort of a better understanding. So what that basically means is, if the market were to move 1%, move your decimal point twice to the left, that means a 1% move is £139. Okay, and currencies don't often move 1% in a day. Okay, so in order to work out your margin requirement, well, Forex trades at 30 to 1. Okay, so take the notional value, divide it by 30, or if you're going to trade it as a stock, divide it by 5. If you're trading a commodity or an index, divide it by 20. That gives you 13979.2 divided by 30. That's your 30 to 1 equals your margin requirement. That's going to be less than that because pound dollar is trading at 1.2, broadly speaking, at the moment. That effectively means for every pound you want to do on your account, pound per point on pound dollar, you need approximately 465 quid. Okay, is this making sense? And is this reinforcing? Is this of benefit? Are you learning something today? Let me know, please, in that questions box. For me, this is fundamentals and probably a lot of the stuff that actually some people who trade probably don't even know, and yet they're trading. But I say, hopefully it's useful. Let me know so we get as many yeses or nos in the questions box, please. Okay, let's go through another example. There's loads of examples. The dollar yen, I won't take long on these as we go through because I sort of did that ad nauseum really. But dollar yen is typically, because of how it's priced, typically that will trade to the second decimal place. So instead of it being 4 decimal places like pound dollar, dollar yen, pound yen, euro yen will trade just after the decimal point. Again, brokers will often show you a quote where it is, a bigger font. Okay, so what this does is it gives you, again, the spread of 0.8, but it's to the second decimal place. From 41 to 42, it's really I don't know why they bolded both numbers, but from 41 to 42 is 1 pip. Forget the 0.2, forget the 0.0. That's not really relevant at this point. Okay, notional value again. Well, let's work out, how do we do that? I'm going to do a pound a point, and what I'm going to do is work out the number of pips. Well, look, the number of pips is really down to there. Forget what's after that. That's the number of pips, 108.42. 108.42 times by your stake per point. Well, I want to do a pound a point. Okay, well, a pound a point, that basically means it's a £10,842 position. Okay, and if you're trading CFDs, it'll be a dollar position or whatever else it may be. So it'll give you the notional value depending on the type of trading account that you're trading with. The notional value and the margin, notional value divided by 30, which is 30 to 1 leverage, gives you £362 per £1 stake. Okay, should be, again, relatively straightforward. Take a photo of it if you want. If this helps, take a quick screenshot of it. Again, the recording will be uploaded onto Facebook instantly after this session. So, and YouTube and LinkedIn and whatever else, you can go back to it. It'll be on our website as well. Okay, FTSE in index. pretty similar, typically trading at 20 to 1. So what you've got there is a market. This has got a 2-point spread because it's from 31 to 33. Notional value, yep, I'm going to do £5 a point on this one. So you take the price, 6933, times it by 5. That's the £34,665 position. Okay, and the margin required, the amount of money that is required to have that is that figure divided by 20 is basically 1733 for every £5 staked. All right, so it's just, often you need to see how that reconciles there as well. So that's reconciling with that. So that's the calculation. Why is it slightly different? Probably like a fractional price or like a dollar rounding or something like that. I don't know. Okay. Well, that's slightly different for some reason. Okay. And then finally, let's have a quick look at a trade example so we can see how that kind of thing works. Again, £3 a point. Let's say you wanted to do a spread bet. You want to do £3 a point on pound dollar. Let's say you wanted to buy at 139.70.4. So the price is currently trading at this. So you can sell at 69.5. You can buy at 70.4. Okay, so those are the prices. But you're going to buy £3 a point on pound dollar at 139.70. You're going to pay the offered price. Okay. The notional value of that trade will be the price times by the stake times by the price, the number of pips that are in the price. That gives you notional value. The margin requirement will be that figure then divided by 30, which is 1397. Okay, I've got slight rounding errors here, but it doesn't really matter. So let's assume the price rises to 13990. Now remember, when you're going to buy, you pay the buy price. When you're going to sell, you pay the sell price, which is called the bid or the ask. Okay, so it needs to quote your sell price at 13990 there. Okay, now we've still got a 0.9 spread, which means the offer price, not the bid, the bid price, when I'm talking about, not the bid and ask. So here the offered price is 13990.9, but the price I need to sell at needs to be the price on the left side. Okay, so we decide to close that position out. Our profit is the difference between our entry price and our closing price, which in this case is 19.6 pips. Again, notice how I don't put the decimal point there anymore. So easy for calculation, really. I think about it in a slightly different way. So I think about it in terms of the decimal point behind the fraction of the pip. Okay, you don't have to do that. You can do whatever works, really, but I've always found that a bit easier. Okay, so that's 19.6 pips. We did that at £3 per point. That's a £58.80 profit, which that as a percentage of your margin is a 4.2% return on capital employed. So in order to place that trade of £3 per point on pound dollar at that price, you needed best part of £1,400 on your account. You made £60 near as damn it out of it, which is approximately a 4.2% return. Okay. Making a loss on a trade, we have to show those as well. That's part of trading. So doing it the other way, we're going to sell. We're going to go short on pound dollar because we expect prices to fall, and we're going to sell at the sell price. Okay, that's the price on the left-hand side. We buy on the right, we sell on the left. Okay, so what then that gives us is a notional value of 3 times by the price at which we sell, which is that, divided by 30, which is the margin. Pretty straightforward. We should be okay with this by now. The price rises. Oh my God, it's going the wrong way. Okay, it goes up to 13990. The problem is we have to pay the offered price. Okay, the ask price. So it rose from 13969.5 to 13990. That's a 21.4 pip move against us. So what we've lost on that trade is 21.4 times by 3. That's a £64.20 loss. That's basically how it all works. Now there may be other costs associated depending on the broker you're trading with. You might have cost of carry for holding a trade overnight. It might be there's a commission if you're trading with a commission broker. I don't trade with a commission broker, but because as a spread bet, it's all built into the spread. But it depends on who you're trading with. Okay. So that's pretty much it of some of those essentials. Is everyone okay with this? Give us a quick yes or a no, please, in the questions box. You okay with what we've covered so far? It may or may not be groundbreaking, but you know what? doesn't mean it's not important. So give us a yes or a no, please, and then we can move on. Good. Edward, thank you. Josh, Henrietta, Romano, excellent. Okay. I want to move on from this now, and I want to think about trading plans. Now, I want to try and get this done in sort of 15 to 20 minutes. So hopefully I can. From my perspective, I look at this in a way that, a lot of traders don't do very well, and a lot of traders quit after a short period of time. And why is that? You get expressions like, a fail to plan is a plan to fail. And, I think there's a lot about that, with trading. There's many ways in which to make money from trading. You need one, okay? But what you do need is you need discipline as well. And the problem is you can only really have discipline if you know what you need to be disciplined to. And I think a lot of that comes down to having the right trading plan, okay? The less you have a plan, the more likely it is you haven't considered what you need to be doing, the more likely it is you're going to break your rules because there were never really rules in the first place. And this is why a lot of people lose. It might simply be that they have a good strategy actually, but they're not following it correctly. Or maybe they haven't got a strategy in the first place. So what is a trading plan? In my opinion, a trading plan is a series of information that you jot down so that you can have something to follow. Basically, it's as simple as that. It's no real different to having a business plan. It's no real different to having a pre-flight checklist. These are things that, of course, you would have if you're going to set up your own business. Of course, you'd have a business plan, wouldn't you? Obviously. You're going to be risking money on it. You're going to be risking your time on it. Why is trading any different? I imagine a much higher percentage of business owners formulate a business plan than traders do a trading plan. And yet, actually, the risks and so on of failure are probably similar. What is it? Something like, I think about 90% of small businesses or startups fail within a few years. So I remember a stat like that somewhere. Those that fail, why do they? Have they considered who their customers are? Have they considered where they are, the price points, their competitors? They consider their costs, what it costs to recruit people. Have they considered the tax, or what it costs of an office? Have they considered all of these things, whatever they may be? And I think a lot of it, trading, we do need to do it in a similar way. Sure, we can take a gamble and we can have a little punt because we heard some bloke down the pub telling us that, pound dollar, that's going to go up. What a boring pub conversation that would be. But in any case, those conversations probably happen and people do take trades accordingly. However, if you want to do it seriously, and I say seriously, you want to do it with a view to making money from it consistently, then really you need to do the same sort of thing that any viable business person would do. And you need to have a certain level of checks off each trade you're doing, what you're doing, to making sure that you don't break those rules. Okay. Now, I'm not saying it's got to be this horrendously complicated thing that you've got to put in a portfolio and carry it with you everywhere you go. Not at all. There are certain things, though, that you do need to consider. Because if you don't consider these things, the chances are a lot of it ends up coming down to luck, coming down to chance, coming down to hope. And I don't really want to put my trading future in the hands of chance and hope, to be honest with you. So, like one of our members here, if you can follow rules, take time and listen to your coaches, you'll make money. If you don't listen, have no patience and can't follow rules, go and do something else because trading isn't for you. So here, forgot to follow the rules, this guy. Trading is important that you have rules. Whether you're using a trend signal strategy, whether you're using something else, it's important that you do try and stick to that, whatever those may be. That's not to say you stick to it blindly. That's massively important. You've got to review what you do. You've got to check whether your rules are still valid, whether they're still appropriate in the marketplace. But here you can take a photo of this if you want to. These are some of the things that I recommend considering when formulating a trading plan. So, and I say this, I remember it was probably about 15 years ago, there was a chap, his name was Andrew, I won't give his surname, but he wanted to set up a managed account program, and he wanted us to help him with the license for it and so on. So we spoke to him about it, and he gave us a track record of all his trades, and then but there was a few howler, really bad trades in there, and he's like, oh no, well those were not part of the strategy. Those loss making ones, they were something else. They weren't part of the strategy. It was like, well, okay, well I can't really use the track record and just select certain trades and not take certain trades just because you happen to tell me they weren't part of the strategy. The point is, whether they were part of the strategy or not, he was obviously breaking his own rules in order to take those particular trades. And those trades cost him a huge amount of money. The rest of his trading was great. But those other trades, they were horrible. Now, why did he get those? Was he feeding a bit of a line as to why he lost on those? I don't know. Maybe we never really progressed any further with the managed program. But what I can tell you is that he clearly broke his trading plan on those opportunities. And in doing so, he went and had a couple of horrible losses, which completely annihilated his account. So, you do need to be careful of these things. Time frames. You need to choose which time frames you want to trade off. And if you find yourself on something else, so let's say, for example, I want to trade on the daily chart. It's my favorite time frame because of X, Y, and Z. You find yourself scanning and looking for an opportunity on the 15-minute chart. You've got to ask yourself, what the hell am I doing, Adrian? Get off this, stop it. Or you've got to make sure you do it on an informed basis, not just because you want the markets to dance for you because you've got a spare hour. Oh, I've got a quick hour here. The kids are away. Let's have a quick look and see what's going on in the markets. Fantastic. It's not with your trading plan. You're probably trading all sorts of weird and wonderful stuff. So make sure you do it on a considered basis. Which markets are you going to trade? Again, be conscious of which markets you are going to trade. If it's going to be Forex, I'm not saying, blindly stick to Forex. What I'm saying is make conscious decisions. And if you find yourself going away, don't just suddenly start trading pound dollar if you've never traded Forex before. Just because, yeah, why not? Some bloke talked about it the other day. I thought I'd just have a quick go at it. Again, fine. Bring it into your trading plan if you want to do it. But just have a little bit of, be mindful of it and make sure you understand what that really means. Once you've got a clear strategy, I'm very clear about which markets I trade according to the strategies that I trade. So if I want to trade, say, the D1 sniper strategy, I'm very specific on the markets I look at. Would I apply that strategy on something a bit rogue? No, I wouldn't, not without really giving it some extra consideration. And because of that, I'm not a gambler. And that's really the way to look at this is, am I having a bit of a punt here, or is this more of a considered opportunity that I'm looking to take? Because it's that approach. I've always been very risk averse myself. It might sound kind of odd as a trader, but I've always been very risk averse because I've always felt that, the more you look after the risk, the profits will look after themselves. It's sort of a where you think about, you look after your pennies and the pounds look after themselves. It's a similar sort of principle, really. If you look after the risk side of things, then your profits will naturally come. So your bad trades become better, and so on. So stick to the markets that you want to do. Which might those markets be? Hey, it's your plan. You got to write this stuff. You got to, even if it's on the back of a paper, and you just piece of paper and stick it on the wall. If it's just a bit of a scrap there on a note, but whatever it is you want to do, write it down. Give it 20 minutes of thought. How much will you risk on a trade? Is it £100? Is it 1%, whatever it is? Think about it. If you find yourself breaking that, then you need to have a word with yourself. How will you look to increase your risk or maybe decrease your risk? You need to put that in. Are you going to compound your account? You're going to say, right, if I get my account from £5,000 to £10,000, I'm going to increase my account. Build it into the plan. Because again, it stops you getting too aggressive and getting carried away if you don't need to be. Think about your strategy. What gets you into a trade? What gets you out of a trade? How are you going to manage those trades? What other factors should you consider? Economic data, etc., etc. And how will you review your trades? Have you got the time? Would you review your trades monthly, quarterly? Have a quick look through. Is my strategy still appropriate? I don't know, really. Let's have a look through the trades. Have I been following my strategy? I don't know. Have a look through the trades. Having that review of what you're doing can really help. Now, as a golfer, I don't play quite as much as I used to because I've got young kids, but I would always, at the end of every round, when I was a little bit more competitive than I am now, I would always go back through my round and look at where I'd gone wrong. What were my bad shots? Why did I hit a bad shot there? What can I do about it? I'm not going to sit there chastising myself because I hit a few bad shots. We all do. We all have bad trades. The question is, should I have done something different so that I don't make such a bad trade in the future, so I don't hit such a bad shot in the future? So it's all about that. What could I do to improve my results going forward? Okay. And this is important. And actually, it's actually really important to review your winning trades, not just your losing trades. Very often we can get blinded by just focusing on what our loss-making trades have done. But actually, if you review your winners, sometimes you may have broken a couple of rules there as well, and you just got to think about that as well. That's all I would say. Okay. So first thing, choose your timeframes. Okay, we'll whiz through this relatively quickly, but choosing your timeframes is probably the most important decision you're going to make, because your time frame is effectively your interval. It's how frequently you're looking to make a decision. So I trade on a daily chart mostly. I jump around on some other stuff from time to time, according to my plan. That is, by the way, before anybody says anything, but typically day to day I trade on a daily chart. Why? Because it suits me, because I'm busy. I've got 3 kids and a dog. I've got stuff to do, but I can trade nicely in the evening. I can have a look once or twice during the day as well. It suits me. Okay, so you've got to think about when you can trade, and your strategy and your time frame should be according to that. So because I mostly look once a day, for me means the daily chart's going to be pretty good for me. If I was going to trade a few times a day, I could trade the daily chart and be a little bit more active with it, or monitor it a little bit more, or I could trade probably the 4-hour chart, okay, the 240-minute chart. It's a pretty cool time frame to trade, particularly if you can be a little bit more active. If you've got more time to trade, then you can trade the shorter time frames, of course. But the strategy you trade and the type of trading should be based on the time frame you trade, and the time frame you choose is based on how much time you have. Okay? Do you only have the time to look for 20, 30 minutes a day? If so, you need to be looking more at the daily chart. If you've got more time, let's say you could allocate 2 or 3 hours to this and you actually want to, and don't forget, not everybody wants to day trade, but some people do, and that's great. I have no issue with it at all. I think it's a great way of doing things, as long as you have the time to do it. But if you've got a couple of hours in the day to do it, you can go right down to, say, a 2-minute chart maybe. It's just a question of whether you have that time. Can you day trade on a 2-minute chart in 20 minutes a day? Good Lord, no. I really would not recommend you being anywhere near it. Could you day trade with a couple of hours a day? Yes, you could. If you day traded for 20 minutes a day, how would you get on? You'd probably lose, because you'd get frustrated. You're expecting the markets to do something for you just because you happen to be looking at it, and you want action, action, action for the 20 minutes you're trying to put it in. You're trying to force it, into something where the market's not really like that. You've got to trade alongside the market, not force it. Your choice of time frame can then actually choose for you the types of markets. The higher the time frame, the higher the time frame, the bigger the targets typically, which means the bigger that you can accommodate dealing costs. Okay, so I should say it the other way probably. The shorter the time frame, the shorter the trade duration, which means the shorter the targets, which means the shorter the spreads really need to be relative to the speed at which it moves. So the shorter the time frame, you want faster markets with tight spreads. Okay, that's why I tend to put indices as really good markets for day trading, because they typically have decent movement during the day on a day-to-day basis. Yeah, sure, other markets like a pound dollar can move really fast when something's going on, but really they're not the most economical markets for day trading or intraday trading. Higher time frame, yes, absolutely, they're fine, but very short term indices is where you get much more range for your spread, for your dealing costs. The higher the time frame, the bigger the moves you go, the more you can trade on a higher time frame, the more markets you can look at as well. Because the more markets you look at, some of them end up being a little bit more expensive to trade. But if you're trading, say, for a 10-point target on a 2-minute chart, and you've got a 1-point spread, that's 10%, effectively 10-point target, 1-point spread, that's a 10% dealing cost, if you like. That's acceptable. Equally, if you're looking at a 100-point target with a 10-point spread or a 20-point spread, again, that could still be acceptable. Okay, so it's just something that's relative. The higher the time frame, the bigger your targets are likely to be, which means the more you can accommodate dealing costs, which means the wider your net can be for markets, which means the more opportunities you could get as well. So sometimes we get people say, well, I only want to trade the Dow and I want to trade it on a daily chart. Well, crikey, you're going to be waiting a long way for a trade. You're not going to get a trade very often. Really? I thought I'd get a trade every day. Why on earth would you get a trade every day looking at the daily chart on the Dow? No. Why be forced to stick loyal to one market? What a ridiculous thing to do. Day trading, fine, that's okay. But trading over 4-hour charts, daily charts, you can actually look at a wider array of markets. Give yourself more choice, more flexibility. Why not? Okay, probably done that a little bit to death, but again, hopefully it's kind of useful. Entries and exits, how to manage trades. To be honest, that's kind of down to you. I'm not here to talk about trading strategy today. I've got many different webinars and events and strategies that we teach here at Trend Signal. But whatever it is, you need to write down what determines an entry point. I need this, this, and this to happen. Great. Because if you find yourself pressing the buy button when this and this and this hasn't happened, then you should be having a word with yourself, shouldn't you? What determines an exit? Why would you look to an exit a trade? Write it down. The more we write it down, the more formalized it becomes for you, the more likely it is you're going to follow it and acknowledge it. Okay. How to manage your trades as well. What determines an earlier exit? Is it economic data? Are you running your trades according to your weekly plan? Are you thinking, God, I've got 5 yen pairs open and we're coming into the weekend. I'd rather close off and I'd rather take my profits rather than carry that risk over. Perfectly reasonable thing to do. I do that all the time. Do I write that in? Do I factor it in? So yeah, I'm okay to do that. Am I going to close a trade just because I'm feeling really excited and I just don't want to get carried away with it? It's not really a good reason to trade because that's emotional. But you need to make sure that there are reasons for what it is you're looking to do. Trade sizing. I'm not really gonna talk about how we trade size specifically today because simply I just haven't got time. But one thing I'd say about this is, a lot of traders talk about percentage risk, and I've got no objection, with it. Let's say a 1% risk of your account or 2% risk or whatever it may be. And this is okay. And then you get, and we don't do this by the way, but you get people who talk about compounded results, and it starts off here, and then after a while it grows, and then it goes exponential. And the idea being is someone shows you this really inflated return that comes through from compounded trading. And then what happens is, of course, that you think, well, that means then, let's say I started with £1,000 on my account, by this point, I've got like £50 million on my account. I could still risk 1% of my account on a £50 million account, and I'm going to be risking £500,000 on a trade. Right. It's only 1%. Okay, the numbers just get ridiculous. But the point I'm trying to make here is nobody can manage £1,000 account the same as they can with a £500,000 account or a £5 million account. And that's because the monetary risk is different. Okay. The percentage risk you might go for, 1%, might still be the same. So whilst I say look at 1%, 2% of your account, whatever it may be, is a really good starting point. What you also need to be is true to yourself. You will probably find that there is a monetary number, type of target, size of risk that you are comfortable with. Mine's about £1,000. Okay, so if I start to risk more than £1,000 on a trade, I start to get a little bit sort of anxious. The sweat starts coming in. Okay, that's it. It's just is what it is. I am what I am. I can't really change that. Some people say, well, of course, if you're a trader, you should be able to just keep going and going in confidence. Come off it. It's just it's not real world. So does that mean you can't compound? Of course it doesn't. Of course you can. But what I'm saying is be true to yourself. You will know when you're hitting that sort of level where you're starting to panic. Because if you're panicking when you put a trade on, you'll start to find reasons to close a trade that don't exist other than to make you feel better. And if that's what you're doing, if you're interfering with your trades just to get the sweats under control, sorry, horrible sort of expression, I guess, analogy, then you're trading too big, regardless of whether that's 1%, 2%. Of course, by that point, hopefully you've got a nice big trading account and so on. But the point is, be true to yourself. I know what my number is, and you'll get to a point where you know yours is. And maybe you review that and think, do you know what? Actually, I'm pretty all right with that now. Do you know what? I feel really comfortable. I feel like I could move up to sort of 1200 risk or 300 risk or whatever it is for you. And at that point, see how that goes, but increase it, marginally is really what I would say. And again, if you find that emotional resistance, just peg it back a little bit. Nothing wrong with doing all of that. You don't have to be in such a hurry. But just if you find yourself where your emotions are taking control, then you're going to find yourself down the wrong alleyway. Okay, because then what happens is you're trading what you feel, and you're not allowing the trades to do what it's supposed to do in the first place. And all the profit and the strategy that got you to where you've got, that's allowed you to grow your account to where it's grown to, is suddenly changed because you have changed the the situation. Okay, so just be mindful of it. That's all. Okay, 1%, 2% risk, 5% risk, whatever it is. These are all fine. 5% is probably a little heavy, but again, it depends on individuals and their attitudes to risk. But think about what that means monetarily, and if that's a little bit too colorful, then think about that. All right. Okay, so increasing your trade size. I've kind of gone through all of this anyway. That it's not a race. Just be comfortable. Without increasing targets, either financial or trade size, applies additional pressure. There we are. It's there. Again, take a photo if you want to, whatever it is you want to do. So what else is there? Not a lot else, really. One thing that I really must say is just be aware of things like economic data. You think about your trading plan. Think about the types of economic data announcements you want to be aware of. So when you're thinking about your pre-flight checklist, you think about, oh, there's trade coming up. Okay, what do I need to do? I need to check what announcement's coming out in the next half an hour. What's announcements coming out tonight? Whatever it may be, according to the strategy you're trading, be aware. Have I got a potential banana skin that I'm literally just about to stand on? Well, fine. There's no excuse for these things. Okay, you should be able to know whether there's economic data setting up. You should know whether there's a banana skin you're about to step on. And if you don't know that, like I said, you should know, because all you got to do is look at an economic calendar. If you don't know how to look at an economic calendar, then look at say a one we did on live cast a few weeks ago, which is how to trade news and events. I talk about the most important news items, where to find them, how to get them, how to deal with them, and so on. So there's no excuses. I talk about why it's important, how much it's likely to move, and so on, which way it's likely to move. These are really important little things. Now, you might think, oh God, I've got to go through all my economics. No, you just have a look at that video. Just have a look and see which are the most important items, and just avoid the markets at that times. That's all you got to do. You don't have to be economics whiz kid at this stuff. Or you got to say, oh my God, I've got UK interest rates tomorrow. Do you know what? I won't buy pound dollar tonight. Perfectly sensible. It's going to have a massive impact on the pound. So why on earth would you trade it? You're looking to hold a position for a week. Why on earth would you hold it over, interest rate data? You're going to do it for two reasons. Number one, because you wanted to take a position because of the interest rate data. You did it consciously, and it was part of your decision-making process because maybe you knew something. Someone in the MPC, maybe, I don't know. Or maybe because you just made a mistake and you didn't know. Well, you can know. There's no excuse not for knowing, is really what I would say. Because, when we trade over economic data, the speed in which the market moves suddenly jumps, and that can create problems. All right. It's not hard. You look at the news, how to trade news and events by Trend Signal. Have a look at that, and you'll see all the information about it really clearly laid out. At least I think it's really clearly laid out. And then, like I said, just have a quick review of your trades. Whether it's once a week, once a month, once a quarter, once a half year, I don't know, whatever it is, just do it. Have a look at your trades. Am I still according to my strategy? Am I still managing my trading plan? Does my trading plan need a little bit of a tweak? What have I introduced anything new that I should put into my trading plan? I found that actually this works a little bit better, so I'm just going to do a quick tweak. The more you review these things, the better it'll be. I'm not saying it has to take huge amounts of time. It really doesn't. But just make sure you have a little look at it. Like I said, after a round of golf, I'll sit there and I'll think about what I've done, what could I have done better, what do I need to work on. But I'm thinking positively. I'm not chastising myself. I'm not criticizing myself for it. We all do things in the heat of the battle and so on. We're all going to continue to do that. But the question is, what can we put in place to help us to not do these things going forward? Okay. And we'll still have flaws. But the question is, the more we can remove our flaws. So if we're trading next month with 1 or 2 less flaws than we did last month, then we're going to be in better shape, aren't we? And that's really the way I like to look at it. Guys, that's it for me, really. Hopefully you're all still awake. What is it? Yeah, pretty much bang on an hour. So I always think I'll get these things done in about half an hour, but I just waffle on, obviously. So, but hopefully that's useful. You got a good idea on some of those trading essentials, a good idea on how to put together a trading plan, which can make a real difference to your discipline, to your confidence with your trading. If you've enjoyed today's session, please do let me know in the chat box. Give us some feedback. Maybe there's some other topics that you'd like to know about as well. So if you're sitting there thinking, well, I'd love it if you talked about Adrian, then type it into the questions box and I'll happily to cover that, I'm sure, in a future session. I've been trading for 20 odd years or so now, so there's quite a lot tinkering around up here, and so I'm pretty sure I can put a webinar together on it if it's worthwhile. So let me know. Otherwise, if you're interested in what we do here, just get in touch. You can go to our website, trend-signal.com, get in touch by phone, email. We can find us on all the usual social medias. Just search for Trend Signal on Facebook, LinkedIn, I don't know, Twitter, YouTube, all that good stuff. Okay. All right, everybody. Have a wonderful rest of the week and happy trading. Bye for now.